Chapter 10 is about property, plant, and equipment. Now we're going to go swing away from uh, equity and liability and equity section on the balance sheet or accounting equation, and we're going to move back to the assets. But we're going to chase only one specific asset, which is a long-term assets or property, plant, and equipment. We're going to see what's the goodwill is and what the intangible assets are. Let's go with first thing. What's the characteristics of the property, plant, and equipment? First, property, plant, and equipment are the main characteristics. Those are tangible assets. What means tangible assets? They have a physical appearance. You can see them, you can feel them, you can touch them, you can smell them. The major component is in the total assets is the property, plant, and equipment. So the property, plant, and equipment is the assets that gonna help you for everyday operation in your company. Those are held for the purpose of the business. We're not selling those one. Once you have a machinery that makes shoes, that's what the machinery that you're using to produce the shoes that you're selling for the through your normal sales operation. Again, there's use in operations, and they're the one who generate revenue. They're relatively expensive and lasting long period of time, usually several years. At the end of the useful life or before the useful life, they can be sold or they can be traded in. Let's go and see how we're going to measure those assets. First, we're going to use the cost principle of measurement. What that means, whatever we pay. Cost principle is very easy. Amount that is paid for the asset plus all the costs that makes the asset available for use for the intended purpose. So, for example, if you buy machinery from Asia, that's the cost of the machinery, but that's not the final cost for the machinery. So, if you have to pay the transportation to bring the machinery in Canada, because your operation, let's say you buy machinery in from Asia, but your main operation is in Vancouver. So where the cost, when we go say this is the cost of the machinery, when we put the machine and we say this machine is ready to be used for the intended purposes to make shoes, because we are the shoe company and we want to make shoes. Once this machine starts producing the shoes, all the cost up to that point, we're going to accumulate it, we're going to see how much is it, and that will be the cost for the machine. So what do we need to do? Purchase the machine, transportation, insurance, when the machine travel from Asia to Vancouver, installation cost to install the machine, testing of the machine. And when the people who installing the machine says, okay, this machine is ready, you can start using it. That's where the accumulation of the cost stops. So again, the cost is the cost principle. Either is going to be amount paid for the asset to bring the asset for the intended purpose. Obviously, we're going to remove all the discounts, or it's going to be the market value of the assets transfer in. If we're purchasing the machinery, everything that we have to pay. If we're trading one machine for the other, market value of the asset that we're trading in. Now, let's see what's in the cost. First, property, big component of the property on equipment is land and land improvements. Those are two separate assets. Land has nothing to do with the land improvement. Land is land. Now, what's the cost of the land? What would be the purchase price of the land, plus the brokerage commission that we have to pay, plus the closing costs, survey, legal registration, title, transfer fee, any property taxes in arrears if we have to pay, Cost for grading, cleaning the land, cost for demolition, and removing the unwanted buildings if there's anything on the land. So imagine this. Do you know where Sheraton Wall Center is in downtown Vancouver?
I've
Yes or
never
no?
heard of Sheraton.
Sheraton Wall
You mean
Center?
Chevron?
Sheraton Wall Center. The
No, I
hotel.
haven't heard of
The
it.
hotel, okay. Which hotel do you know where the Fairmount Hotel is?
Yeah, I've
On
heard of that.
Grandview and Barrard.
Yeah, I've heard
Okay.
of it. Yeah.
Do you know where the Vancouver Museum is? On Robson Square.
Never been there.
Never been there? Robson Square, Vancouver Museum. Anyway, let's stay with Fairmount. Imagine this. I'm having money, excessive amount of money, and I want to buy the land where the Fairmount Hotel is. Now the question is, what will have to accumulate as a cost of the land? First one will be the purchase price, correct? Second, brokerage commission, closing costs, survey, legal registration, title, transfer fee. Now the question is, what do I want to do on the land? Well, it's my land, I can do whatever I want, and I decide to grow tomato. In the middle of downtown Vancouver, I want to grow tomato. It's my land, I can do whatever I want. So, what do you have to do? I have to remove the building. The cost of the demolition, cost of the grading the land, until somebody comes and say, now you can grow tomato on this land. Up to that point, all the costs will be part of the cost of the land. Make sense?
Sorry,
Now,
quick question. You
yes.
said like it the demolitioning and the cost for grading, it was part of the land and like you said makes
Can I grow tomato on my land if there's a building there?
no, you cannot.
No, I cannot. Do you have to remove the building? Yes.
Yes.
So until somebody says now you can grow tomato on your land, until that point, all the costs to bring the land for the intended use will be cost of the land.
Okay.
Make sense?
It would be cost of the land. So no, I'm a bit confused where you said like uh cost for demolition. I mean, I understand cost for demolition and unwanted buildings. That's part of the cost of the land basically to get rid of the previous buildings, right?
Correct.
Oh,
Correct.
okay, that makes sense. Thank you.
So can I amortize the land? The answer is no. We don't amortize land. The logical question will be why? And the answer is that land was there 250 million years ago, and magically is going to stay there 250 million years after us. So for that reason, we're not amortizing the land. Now, land improvement, that's completely separate thing. That land improvement has nothing to do with the land. It's a separate long-term asset account, and that land improvement is amortized. Now the question is, what's in the land improvement? Before we do that, if we go to the land improvement, let's see the land. Now we have the purchase price for the land, plus we have to pay the brokerage, we have to pay transfer taxes, we have to pay the removal of the building, we have to pay the survey fee, all this cost of the land, we adding it, we adding all the costs, whatever the total cost is, that's gonna go to the account, asset account, land. $546,000 debit land account. Credit cash for the same amount. And we're done with the land. Now let's see the land improvement. What's land improvement including? Land improvement including lighting. So if I need lights on my land to grow my tomato, That will be land improvement. If I have to put the sign, don't touch my tomato, it's a private property, that will be land improvement. If you have to put the fence, so people don't walk over my tomato, that will be land improvement. If I have to put the sprinkler system to water my tomato, that will be land improvement. If I have to do some landscaping, so I can put one tree in the middle to make some shades for the for my workers that when they bearing the tomato, that will be landscaping. All those are part of the land improvement. Now the land improvements again, those are amortizable assets. The separate account has nothing to do with the land. As you can see, land improvements, paying cash, debit land improvement, credit cash. That's with the land and the land improvement. Now let's move to the next category, which is building. For the building, you have two options. Option one, you can build the building by yourself by constructing the building, or you can purchase the existing building. If you have to build the building by yourself, first you have to pay architectural fee. Then you have to go and beg the city for building permit. Then you have to hire those contractors because you're going to charge you a fee. Then you have to pay for the material, labor, overhead. If you borrow money, you have to pay the interest on the borrowings. So all this cost will be added to the cost of the building. That's in case you have to construct the building. Now, if you purchase the existing building, again, don't forget, if can I buy a warehouse and turn it into hotel? My idea is to run hotel business. Obviously, I can buy whatever building I want. Now, the purchase price will be part of the building. Second, legal fee to transfer the title of the building and the land and everything. Third one will be the repair and renovation cost to bring the building that I just purchased into the intended purpose, which is to run hotel. When somebody says, now it's ready, you can have your first hotel guests, that's where the accumulation of the cost stops. Whatever is accumulated as a cost, that becomes the cost of the building. That's with the building. Now let's see what will be the next category. Next category can be equipment or machinery. Again, don't forget, we're accumulating the cost until the equipment or machinery is ready to be used for the intended purpose. Imagine this, your dishwasher, you want to buy a dishwasher. You're going to Home Depot and you're purchasing dishwasher. Can you start washing your dishes?
Probably not.
You just bought it. It's sitting in the box. Can I put my dishes inside, put the detergent, start washing my dishes?
No, you can't.
No, I can't. Okay, but I have the machine. It's mine, right? I just paid it. So what else I have to do? Magically, that machine from Home Depot has to come to my apartment, correct? Because I'm not gonna go with my dishes from my apartment to Home Depot, put the dishes inside the dishwasher, put the detergent, wash my dishes, then get the washed dishes from the Home Depot and bring it to home, right? That's too much. So it's better instead of bringing the dishes every time when I need to wash them, better go get the dishwasher and bring it to my place. So I have to transport dishwasher to my place. Okay, fine. Do I need to buy insurance for the time when this dishwasher is on the move? What do you think?
Yes, because like if something goes wrong with it, you're just stuck with like a piece of junk.
Exactly. So, okay, I bought the insurance. Do I have to install the dishwasher? So the dishwasher comes in my place. Now it's in my place, but it's still in the box. Can I use it? Can I start washing my dishes?
No, you can't.
No, I can't. Why? Because somebody has to install it. Okay, the installation is done, the machine is connected. Can I start washing the dishes?
No, you can't because you have to test it out first to see
Exactly.
if it
Somebody
works.
has to test it, and when somebody tests it and says, now the dishwasher is ready to be used, then you can start using it. So, for that reason, keep that in mind because it's going to happen to you at least one or maybe two, three times over your lifetime. You have to buy washer, you have to buy dryer, you have to buy dishwasher, you have to buy oven, you have to buy all those appliances. So first, you're going to have purchase price, but your problem is not solved. Now you have to transport it magically from the place that you bought it into your place. Second, third one, you have to install it. After you install it, you have to test it. And once you test it, you can start using it. So what you have to do when you're going to the store and start asking how much it costs, make sure that the transportation, installation, and testing are part of the cost that you pay. Otherwise, you have to pay separately. You can get a very good deal from Home Depot or from other retailers on the price, plus including transportation, installation, and testing. And guess what? You don't have to worry about the insurance because if the transportation is included in the purchase price, the insurance is on there in their cost. Why? Because I'm the deal is completed when the machine is delivered to my place, installed, tested, and somebody, the guys who testing it, saying, now you can use it. That's where the sales is complete. If something happened in the middle, I'm not responsible. You transfer the liability directly to the seller. Make sense? Be careful with that. The other categories of the equipment can include vehicle, furnitures, computers, storage racks, display shelves, anything like that. Again, looking for significant assets, which is going to be used over several years. Now, this is the assets. How about leasehold improvements? If you're leasing the building is not your asset. Let's say I'm leasing the building for I'm trying to make a school. I have to run my own school, and I'm leasing the building. Okay, I'm leasing the building. The lease I signed the lease for 5 + 3 years, 8 years lease. Can I start doing the classes inside the building? Most likely no. So what do we have to do? Then I have to build the classrooms. Then I have to put the equipment, which projectors, whiteboards, anything like that. I have to buy computers for every classroom so I can run the slides. Once I do that, all the renovation that I'm doing on the building, which is under my lease, which I have to pay the lease, to bring the building for the intended use, that will be called lease improvements. I'm going to capitalize that cost, means I'm going to keep it on the balance sheet, and I'm going to amortize it. That cost will be amortized over the life of the lease or term of the lease, including the renewal options, because as you remember, I had it for 5 + 3 years. Now on the amortization will be term of the lease, which including the renewal option, or useful life of the leased asset, whichever is longer. What's
Sorry,
gonna,
you said
yes,
whichever is shorter or whichever is longer.
longer. So sorry, whichever is shorter, whichever is shorter, because you want
Oh,
to amortize it
okay.
as soon as possible. If the useful life, let's say I'm leasing a building for 8 years. Obviously, building is not gonna useful life of the building is not gonna be shorter than the lease period, correct? So in this case, whatever is shorter. So let's see what's gonna happen. Imagine this: you're going to the a question for you before we go to that example. Question for you: if I go and buy from Best Buy a laptop now, just laptop, pure laptop, can I use it?
You'd have to set it up first.
I have to set it up first. What that means? I have to install some software in the laptop.
Yeah.
Do I have to pay for the softwares?
Yes, you do.
Yes, I do. Or I can get a bundle price from the Best Buy, correct?
I think that's possible, yeah.
It's possible. So watch this. When you pay a single price for the several assets, which can be identified and sold and purchased separate, then you have to assign some cost to those assets. So let's say I'm paying $1,000 for laptop plus uh, what will be that? Office 365 and some other software which I can purchase outside. Let's say Adobe. So the laptop is one asset. Office 365 lifetime software. It's another software, another asset which I can buy separate. And Adobe subscription for 5 years, I can also buy separate, but it's all included in $1,000. Now the question is, how much cost should I assign to the laptop? How much should I assign to the Office 365? And how much I should assign for Adobe? Now the single rule is very simple. First, we're seeing what would be the fair market value of each of the assets. So let's see, this example is assuming that this person is buying, this company buying land and building, which can be both separate, but they're buying it together and paying together $540,000. Now the question is, how much should I assign to the land? How much should I assign to the building? What they're doing is very simple. They're chasing the fair market value of each of the assets. Since they have two assets, land and building, I'm chasing the market price for those two assets. And I find out that the fair market value for the land is $200,000 if I have to buy it separate. And for the building is 400,000 if I have to buy it separate. Okay, those two give me total $600,000. But I'm paying 540,000. So how can I allocate 540,000 to those two assets? So based on the market value, I see what's the portion of the land out of the total and building out of the total. So I'm finding out that land is 1/3 of the total number and the building is 2/3 of the total number. So that means 33.33% and 66.66% here. Now I know how much I paid as a total. So basically, from the amount that I paid, 1/3 I'm going to allocate to the land, and 2/3 I'm going to allocate to the building. And my problem is solved. This is called purchase lump sum or basket purchase of assets, and allocation is called proportionate allocation. Which proportion are we using? We're using the proportion based on the fair market value of the identified assets. Make sense? So once we come up with those amounts, I can easily debit a land account with 180,000, building amount account with 360, and the cash that they paid, $540,000. And that will be my journal entry. In this case, they pay only 90,000 cash. The other one is they sign a long-term mortgage. What's the betterment and what's the repair? As you can see from the name, is betterment is technically it's improvement of the assets or make the asset better by either increasing the capacity, either the increasing efficiency of the asset, or by extending useful life of the asset. So make the asset better. That's why it's called betterment. Repair, on the other hand, doesn't extend the asset capacity, doesn't extend capacity efficiency, but maintain the asset so you can use it. Here comes the example. You purchase a car. You're using the car for your normal operation of the business. After 50,000 kilometers, you have to change the brakes. Changing the brakes, the discs, not the disc, the pads on the discs, the pads on the brakes. The disc, you don't gonna change it. This lasting more. They're probably gonna last you at least 150,000 kilometers. But you changing the parts on the brakes. Is this a repair or betterment?
Is it a repair?
Any other suggestions? It is repair. Why is not a betterment? Because it's if you don't change the brakes, if you change the brakes, it's not going to extend the useful life of the car, but it's going to maintain it so you can use it for the intended purposes. For that reason, it's repair. However, if you change the engine of the car and putting a brand new engine, which now is going to extend the useful life of the asset with another 5 years, that will be considered better. Make sense? So let's see what's the ethical issue here. Ethical issue first. Which asset should I capitalize and which asset should I expense? Can I expense a truck? Believe it or not, I was checking one company, and what the accountant did is the owner asked her, "How are we doing on the taxes?" She said, "We're great. We have a lot of expenses. Most likely, we're going to end up a year on the loss." And he's asking me, "Can you please check all my records and my accounting because something is going on here?" So I'm checking, and what the person did was there was a truck purchase of the truck, $350,000 truck purchase, which was directly expensed. So that's one way to look at the problem. So basically, if you need to expense, what you can do, you can expense the long-term assets. Is that the right thing to do? No. What do you have to do? You have to capitalize the asset and amortize it over the useful life of the asset. The next thing is fair market value of the asset. What is the fair market value and how can we determine it? Imagine this, I'm a owner, I want to open my own company and I want to bring my laptop to be part of the assets of my company. I purchased the laptop for $1,000. But when I'm opening my company, I'm saying this laptop now, because it's mine, I touch it with my fingers and I never, clean the keyboard. And also, when I was in my trip, I accidentally saw which one I saw. So let's say Brad Pitt, and he touched also the keyboard. Now my laptop fair market value is $50,000, and I'm recording, making debit as asset computers $50,000, credit capital account $50,000. Is that ethical? How did they come up with the 50,000 fair market value? The other thing is, when you have the expenses, should I expense it or should I capitalize it? What should I do? There's so many interesting things with capital assets you have to understand, and there's so many opportunities here, not only for the mistakes but also for the manipulations. And there's solutions for every each of those. For example, for the fair market value, how can I come up with the fair market value? Well, technically, you don't, but you can hire independent valuator who's going to give you the fair market value. And when that independent valuator for which you're going to pay, they're going to give you the fair market value, and then the auditor comes on the audit, there's nothing they can say because you're going to keep all the documentation. And when they ask you how you come up with the fair market value and are you biased here, you're going to show the certificate from the independent valuator, which has nothing to do with you, and he come up with this value. End of the story. Which cost to be capitalized and which to be expensed? Be careful with the purchase of the assets. Don't expensing cost which is part of the purchase price of the asset. And after that, after the period start, when you start using the assets, be careful how you showing the amortization and how you showing the expenses. So in order to be consistent with yourself, what you can do is when you become a controller of the company, make a policy for different type of assets. Come up with the scenario of all possible scenarios for the assets, put it in the policy of the company, and you're avoiding all the conflicts and future implications. That's how you deal with the ethical issues. Now, let's see what we're going to do. Now we have the assets. What we're going to do with the assets? We're going to use them for the operation of the company. But once we use them, those assets start to amortize. What's amortization? Amortization is clearly transferring the cost of the asset over the useful life of the asset. Now, we have to see which cost we have to transfer. Only amortizable portion. How are we going to get that amortizable portion? Well, first, we're going to see what's the original cost of the asset. Second, we're going to see At the end of the useful life, can I sell this asset? Can I salvage anything from this asset? If there anything, residual value of the asset, we're deducting it from the cost because you're gonna get it door by door. And what you have to do, you have to amortize the difference over the useful life of the asset. That's how we're gonna match the expense with the revenue that we're gonna earn from using the asset over the useful life of the asset. Now, the amortization can be physical, wear or tear, and can be also related to obsolescence. Amortization is also called depreciation in the reality of the accounting standards for the private enterprises, which we are. We are in the reality of accounting standards for the private enterprises. Once you move to international financial reporting standards, depreciation is used for one asset, amortization used for another assets. But you're going to see in the intermediate accounting when you see my colleagues there. Now, what's amortization is not? Amortization is not cash outflow. So in other words, can I go to the store and buy amortization? You can try, but unfortunately, you can't. So the amortization is not cash flow, a cash outflow. And it's not a process of valuation. So how are we going to measure the amount that we have to amortize? Again, we're going to get the original cost. We're going to get estimated useful life or length of the service or number of units that this asset can produce. Then we're going to estimate the possible residual or salvage value that we can get as a cash at the end of the useful life of the asset. And we're going to amortize only the cost less the residual value or salvage value. Those terms are used interchangeably. A residual value, salvage value, you can see it one or the another. All means the same. So cost minus the residual value will be the amortizable cost that we have to amortize over the estimated useful life of the asset. So that brings us to the assets and how and what we're going to do with those assets. First, land, no amortization. Land improvement, amortization, depreciation. Building machinery, equipment, furniture, fixtures, computers, anything like that, amortization, depreciation. Natural resources, amortization and depletion. Now, the natural resources, we have depletion. Why? Because once you're using something, it just disappears. Intangible assets, amortization. On the goodwill, we're going to see what the goodwill is later. Impairment loss. So this is the assets, this is the related expenses or losses that we can have from these assets. So let's start with the amortization method. So now we have to amortize, obviously we have to amortize asset by transferring the amortizable amount over the useful life of the asset. How many methods we have? We have three basic methods. One is the straight line method. What does mean straight line method? Straight line method is amortization doesn't change period after period and stay the same. Unit of production. What means a unit of production? We're gonna amortize only and only part of the assets which is related to produce the units of output that we're producing. And the last method is declining balance, which we're going to start using a percentage, which percentage is going to start reducing the value of the asset. Let's go with the first method. Now, what I can do is I can get this question now, and I can move to Excel spreadsheet. Shall we move to Excel spreadsheet, or you want to stay on the slides only? Excel, please. Okay, let's go to Excel. Sometimes when you're posting on the chat room, I don't have it just right in front of me, so that's why sometimes I'm missing whatever you're posting me there. I apologize for that, but I have the Excel now. Let me paste this one as a picture, and let me get the other parts of the slides, which is this picture here. And I'm ready to share my screen with Excel spreadsheet. And that should be the one. Okay, I have those two pictures. What I have is assume we purchased a truck on January 1st, 2002, and the year end is December 31st. So what do I need to find? I need the cost of the asset. Let's make it bigger. A little bit bigger. I need to get the cost, original cost. Let's go original cost. Then I need to get the residual value, which is estimated residual value. And I have to get amortizable cost, or the amount that I'm going to amortize over the useful life of the machine. Cost is given, or cost you can get it. Original cost is 65,000. Let's put the dollar amount here. Estimated residual value at the end of the useful life of the machine, I can sell it for 5,000. So how much I have to amortize over the useful life of the machine? If I pay now 65, later on I can get $5,000 cash. The amount that I have to amortize is gonna be 65 minus 5. So I have to amortize $60,000. Next thing that we need to know is how many years we're gonna use the machine. Well, our estimated useful life is 5 years. If my estimated useful life is 5 years, how much is the amortizable cost per year? 60,000 divided by 5 years. Every year I have to amortize $12,000. Magically, how many months the year has? We already know the months per year has 12 months per every year. So what that gives me? Amortizable amount or cost per month will be 12,000 divided by 12, $1,000. And we're done with this. So now what we have to do, the next thing that we have to do is to prepare amortization schedule. To see how much I have to amortize every year. For the amortization schedule, we're going to start with year 0. That will be the year that we're purchasing the asset. Then we're going to go year 1, year 2, and so forth up to year 5. Year 1, 2, 3, 4, 5. I have my 5 years. Gonna put them here in the middle. That's what done. What I'm gonna do is the next thing that I have is the beginning balance. Next thing that I'm gonna have is the amortization for the period. Then I'm gonna have accumulated amortization. Those accumulated amortization. Now, if you want, you can go here with the format cells and you can wrap the text so you can make it like this. Now I have accumulated amortization here. And the last thing that left is will be the ending balance. And we can put those one in the middle and we have our very simple amortization schedule. Now, ending balance, we will start with 60,000. Because the 60,000 is the amount that, so actually, sorry, the ending balance will be the cost, original cost of the machine, which is 65,000. Now, before I even start my amortization schedule, once I draw this line here, the totals, do I know how much should be my total amortization over the 5 years? Let me see what you say in the chat room. 60,000. So my total here should be 60,000. Okay. What will be the ending balance of the account track? 5,000. That's my objective. So before you even start amortization schedule, I know what's my objectives. My amortization to be 60,000. Accumulated amortization has to be also 60,000. And my ending balance has to be 5,000. Okay, let's start. Ending balance, I purchased the machine first year. So beginning balance, I'm starting with 65. So this balance is gonna be this one. I get the 65. How much I'm gonna amortize every year? 5,000. Is this 5,000 gonna change year over year? No, they won't. Sorry, not 5,000. What I'm talking about? It's 12,000, right? We are amortizing 12,000. How much will be my accumulated amortization first year? It's gonna be 12,000. How much will be my ending balance at the end of the first year? It's gonna be 65 minus 12,000. It's gonna be 53. What's gonna happen next year? That 53 is gonna move as a beginning balance. Amortization is gonna stay the same. There will be no change in my amortization. So I can easily put here F4. Amortization is gonna stay the same every year. Accumulated amortization. Second year will be first year plus amortization for the second year. We don't technically, but for simplicity and for better understanding, I always use year zero. Year zero is the beginning balance. But technically, you don't have to put it. And the ending balance again is going to be previous balance minus accumulated amortization for the period. And now if I run those calculations down, if I run those calculations down, and if I run this calculation down, I should get whatever I want to get in the first place. So what we can see here, we can see that our amortization doesn't change. And the total is exactly the amortizable cost. Ending balance for the assets is exactly the residual value that we're expecting to get when we sell the asset. The other thing that we can see here is, if you follow the Excel spreadsheet, is that plus the accumulated amortization, always and always is going to be equal to original cost of the asset. Always. So what that means is, this is your check here. If you wanted to call it checkpoint. If those two together doesn't give you the original cost of the asset, you're making mistakes somewhere. That's how you should look at this checkpoint. And we can highlight it in different color, different like this. And if I run this calculation, always has to be 65, 65, 65, 65. And what I'm doing is, in the beginning, the 65 stays in the account truck. And then I start moving from truck into the accumulated amortization. And accumulated amortization start increasing. The balance of the truck account start decreasing. How it's going to look at the T accounts? Let's do the T accounts and see how exactly it's going to be. The T accounts, I'm going to make it, trying to find here. This will be the right place to do it. So I'm going to have, first I'm going to have account called truck. Actually, I don't need those one. Let's move no borders here and put that this one. That will be my truck, which is asset account. This will be my accumulated amortization. Which is going to have exactly those elements. And the last account will be the accumulation expense. Accumulation expense, I can show it here on the bottom because that will be expense account, that's not balance sheet account.
You will be posting this Excel slide
Of
onto the.
course, of course, always, always. You don't even have to ask me. And the last one was the amortization expense. Amortization expense, that's not balance sheet account, so it's not going to have beginning balance, not kind of debit balance. It's going to be just expense account. So this truck account is going to have beginning balance and it's going to have ending balance. Same thing with accumulated amortization. It's going to have the beginning balance and it's going to have the ending balance. What's interesting is Accumulated amortization is companion account to the truck, but behave the opposite way. Truck, since the asset account, normal balance always going to be debit. Beginning balance will be on the debit side, so maybe I should remove this one, put it here, and get those two together. So that will be my debit here. This will be my debit. On the other side will be my credit. Same thing with the accumulated amortization. This will be my debit. On the other side will be my credit. So this account is going to have beginning balance and it's going to have ending balance. This account also going to have beginning balance, but since it's a contra account to the truck account, the balances will be on the credit side and ending balance. Amortization expense, no balance there. That's pure amortization. So what we're going to do, the first year, when we do the calculation, once we purchase the asset, we're going to have asset at 65,000. And that will be our debit in the truck account, 65,000. At the end of the first year, on December, this is, let's say this is January 1st. And in January 1st, our journal entry will be debit truck, credit cash. Let's keep it simple. Debit truck, credit cash. Truck will be with 65,000. Cash also will be 65,000. No questions about it. Now on December 31st, we have to show our amortization for the year. We use the truck, we have to show the amortization. So what's going to happen? Now, my beginning balance for the accumulated amortization in the very beginning was zero. Nothing. But now I use the truck for the first year. So on December 31st, year one, I have to show accumulated amortization of $12,000. And that's going to continue until year five. Let's leave some space here. So we can have December 31st, year one, and then we're going to have December 31st, year two, three, four, and five. Now, what will be my journal entry? On December 31st, I have to do the journal entry debit for the year one, December 31st, year one. I'm going to show my first amortization expense, 12,000. Again, I'm transferring the cost of the asset into the expenses for $12,000, debit amortization expenses. For $12,000, and I'm showing credit accumulated amortization for the same amount. That's for year one. How this entry is going to change for year two, year three, and so forth? Is it going to change? What do you think? This entry never going to change. It's going to be exactly the same. So the year two, we're going to do exactly the same. Year two, year three. So now I have to make sure those one are reading from themselves. That will be our year two. And three and four and five are all the same. What's going to happen here? Every year I'm going to add 12,000 Year first, 12,000. Second year, 12,000. Next year, 12,000. And keep going until I put every year $12,000. Expense accumulated amortization is gonna every year is gonna be 12,000 up to year 5. And my total balance accumulated amortization will be 60,000. My trunk account, I'm not gonna touch it, but on the balance sheet every year I'm gonna show truck. On the balance sheet, the presentation will be truck 65,000. Then I'm gonna have less accumulated amortization. Let's pretend we're doing this for year 2. Now the accumulated amortization for my year 2 is 24,000 less 24,000. So net of trucks, net truck account is going to show me the difference. That will be 24. Let's put it positive here. And the net of truck will be 65 minus 24. And that will be my presentation. So every year I'm going to add more accumulated amortization, and my net amount of the truck is going to going down until reach 5,000. Make sense?
So, are we gonna get a question like this, like where, it says, what is the ending amortization amount, which is 5,000? Would they word it a bit differently on the quiz, or
No,
how
this
would that work?
the 5,000 is your residual value.
Oh, okay.
Amortizable cost is 60,000. So that's how much you have to
Okay.
amortize over the life of the asset. So the accumulated amortization at the end has to match the amortizable cost.
Okay.
Net of the assets of the truck at the end of the useful life has to match. It has to have truck 65 less accumulated amortization 60, net
Okay.
amount 5,000.
Okay. So like they all have to, so that the amortization cost at the end must be 60,000 while the residual value is 5,000, and they basically all, when they add up together, that should be equal to
Correct.
65,000.
Correct.
Okay, thank you.
And that will be your straight line method. So that's straight line method here. Gonna stop sharing this. Let's go to the slides. Let's see the unit of production, and I'm gonna give you a break. So let's go back to the slides. So on the slides, again, the same picture. What we have to do, the calculation that we already did. Cost minus the residual value divided by useful life is going to give you amortization per year, 12,000. So every year, at the end of the year, we have to do amortization expense, truck, 12,000, accumulated amortization, truck, 12,000. If we have to prepare the schedule again is going to look like this. Original cost of the asset of year 1, year 0 is 65. Amortization, amortizable cost. This is 60. This schedule is a little bit different than what I show you, but again, get the original cost in the beginning as a beginning balance, deduct the amortization expense for the year, see the accumulated amortization, and keep going. Objective, you know the objective. Objective is your amortization expense over the 5 years to reach 60,000. Accumulated amortization obviously has to be 60, and your asset book value has to be $5,000. That's your objective. Again, you already know your objective before you even start the calculation. Make sure you achieve what you want. Now, the second method is unit of production method. For the unit of production method, what we're going to do is we're going to get this information only. And I'm going to move now to the Excel again. And I'm going to explain this one in Excel. Let me share my Excel again. Unit of production method. Let me pause this picture first. And then I'm going to erase everything. And we're going to start again. So, what we need, again, we need the same thing that we needed before. We need the original cost. Which original cost is 65,000. Then we need to get residual value. Estimated residual value 5,000. So over the useful life of this machine or this truck, I have to amortize $60,000. Amortizable amount or cost is 65 minus 5. $60,000. Now, I'm going to use it for 5 years. Useful life is 5 years. Which give me 12,000 per year. We already calculated that. But I also can produce units of production. I can use this machine 40,000 kilometers. That will be kilometers here.
So you entered 400,000 kilometers, not 40,000.
400,000 kilometers, correct?
Oh, okay.
It says
Okay.
here 400,000 kilometers. That's what we know. Since we're going to use unit of production, that means we have to find out how much we have to amortize for every kilometer that we're driving the truck. So how much will be amortization, amortizable? Let's stay with cost per kilometer. How much will be that? Well, obviously will be 60,000 divided by 400,000 kilometers. So for every kilometer that we're going to drive our truck, we're going to allocate 15 cents to as our amortization expense. Now I have to prepare the amortization schedule. So I'm going to start again. Year 0 will be the year that I'm purchasing the assets. Year 1. And year 2, 3, 4, 5. 5 years. The next thing that I need is beginning balance. Next thing that we need is units or kilometers driven. Amortization per kilometer. Kilometer. which always gonna be 15 cents. We already know that. 15 cents will be my amortization per kilometer. Next thing that I need to do is amortization amount, expense, how much I'm gonna expense, how much will be my accumulated amortization, and the last one is how much is my ending balance. And now I can start filling the gaps. In the year one, I purchased the asset that cost me $65,000. Then my beginning balance on the January 1st year one is $65,000. First year, I drove the truck 90,000 kilometers. Second year, I drove the truck 120,000. Sorry, that will be here 90,000. Then the second year, I drove the truck 120,000 kilometers. Third year, I drove 100,000 kilometers. Next, I'm driving 60,000 kilometers and 60, sorry, thousand. And the last year, I drove 30,000 kilometers. The only thing that you can do here is double check those kilometers and make sure that you're actually driving the truck 400,000 kilometers. In this case, that number checked. So we're driving 400,000 kilometers. So if I know that, how much will be my total amortization expenses once I drove the truck 400,000 kilometers? Do I know this amount? Since I'm allocating 15 cents per kilometer, which I use getting from amortizable amount, once I use those kilometers, my amortization expense should be exactly $60,000. So I know that before I even start my chart here. And I know that my ending balance should be equal exactly to the residual value, 5,000. So let's start plugging the numbers. First number will be amortization expense. 90,000 kilometers times 50 cents per kilometer. That will be my amortization expense. Accumulated amortization first year will be the accumulated first year. Ending balance gonna be beginning balance from the year minus the amortization expense. Second year, that will become my beginning balance. Then I'm gonna drive the truck. Then my amortization expense will be accumulated amortization will be previous year plus the new year. My balance will be exactly the same. And now I can run the drop down all the calculations. And once I do that, I should get what I need to get. Let's see if that's gonna happen. Once we run all the totals, you can see that at the end, we achieve our objective. Our objective is we to amortize over the life of the kilometers that the truck was driven, to amortize 60,000, to leave 5,000 as a residual value, ending balance of the truck. Now the next thing that left is, now I have to do all this to show you the T accounts, which now I'm gonna copy it from the previous and post you the T accounts. So again, what's happened with the truck? 65,000. Now the amortization is not gonna be 12 because we're changing it. Amortization will be based on those years, and it's gonna go all the way there. But the total amortization, again, we're gonna be 60,000. Year over year, how this is gonna change? In the beginning, we purchased the 65 truck, pay cash. The first year amortization is gonna be 13,500. Second year amortization is gonna be 18,000 only, and we keep going, keep going, keep going. So at the year 2, how much will be my accumulated amortization? Accumulated amortization in this case will be 13,500 plus 18,000. So the net value of the truck in this case will be 33,500. Does that make sense?
Sorry, I'm a bit confused. Like you got like the kilometers driven from where exactly? Like on the
It's given on the case here.
oh, okay. And like the 90,000 in year one, 120,000 in year
Still given
two.
in the case.
Oh, okay. And the ending, you put the beginning balance first for year zero, which is 65,000 in the ending year, since it's the contra account or something along those lines. Is that correct?
Which one? Which is the contra account is accumulated amortization is the contra account.
Okay.
And the actual account is the truck. Truck is the asset, is the asset account. Contra account is accumulated amortization truck.
Okay. And 90,000 and like to get 51,000 in year two, it's something minus.
51,000. 51,000, it will be the original
Oh, okay.
minus the amortization for the first year.
Okay.
So
Is it
for
written down on the I mean, on
so
the
here
Excel?
on year, so if you want year 1, so if this is year 2, let's move the year 2 here. If
Okay.
you want year 1, how much will be my balance in year 1? It's gonna be truck is 65. For the year 1, my accumulated amortization is 13,000. So my
Okay.
net amount will be 51,500.
Oh, okay.
Year 2, my truck will be 65, but my accumulated amortization now will be year 1 plus year 2. So the net
Oh,
truck of the 33,500. And every
okay.
year, we're gonna add the amortization expense to reduce the net truck amount until the year 6 become 5,000.
Oh,
A-
okay.
And sorry, just to clarify, the accumulated amortization account, that's meant to be like the total of the amortization expenses?
That's correct.
Thank you.
I'm gonna give you 10 minutes break so you can process this, and we can continue with the last method, which is the declining method. Recording, and let's move to slides. And so again, with the unit of production, what you have to do is figure out how much is amortization per 1 unit and follow the schedule of how many units we use each year and just apply that one. Again, the objective is accumulated amortization to go all the way to $60,000, to leave 5,000 on the asset account as a net amount for the assets. Now let's see declining method. Declining method can be double declining, can be triple declining, can be quadruple declining. How are we going to get this one? First, we're going to use the straight line method to get the multiplier. And then either we're going to double it, either we're going to triple it. For example, in our example here, as you remember, we have 5 years. We have to amortize the assets over 5 years. One divided by 5 is going to give you the total amortization for the entire period. So that means every year we have to amortize 20%. 1 is the 100 divided by 5. It represents the 20% every year. If you want to double it, the percentage for the straight line method times 2. If you want to triple it, times 3. What's going to happen? Once we change this percentage, make it higher, in the beginning of the useful life of the machine, we're going to deduct more amortization. So let's see how this is going to work. I'm going to get this calculation again. Not this calculation, this information. And we're going to move to the Excel spreadsheet. And that will be double declining method. So this is my information here. I'm going to post it again as a picture. Now I can use from the straight line method directly. I'm not going to go crazy now. So for my straight line method, original cost is 65. Residual value, I'm going to delete this amortization schedule because now it's going to be a little bit different. Original cost is 65. Residual value, not going to change. Amortizable cost, 60,000. Useful life, 5 years. Now amortization per year, all this is going to stay. Now, for the double declining, what we need is to get the percentage, estimated useful life. How much is every year? How much we have to amortize every year if we have to amortize the assets over 5 years? So we're going to get percentage useful life, that will be amortization cost per year, that will be percentage per year. And that percentage per year, we're going to get it by dividing 1 divided by 5. So our percentage is every year we have to amortize 20%. This per month is useless. So if I want to make it double declining rate, what I'm gonna do is I'm gonna multiply 2 and gonna multiply the percentage. 20% per year times 2, and it's gonna give me the percentage per year. So every year I have to amortize 40%. Now for this exercise here, now on the slides you're gonna have the double declining method. Let's use for this exercise here for us, for our purposes, triple declining. I'm gonna leave this one here with double declining for you to do it later for yourself when I post this Excel spreadsheet to you. I'm going to use this information. I'm going to change it. I'm going to give you extra for the triple declining method. So in order to make a triple declining, I'm going to, instead of double it, I'm going to triple it. So my amortization that I'm going to use is 60%. So again, I'm going to get year 0, year 1, and keep going to the end. Year 5. Oh, that's year 6, so now I've started a little bit higher. 0 here, year 1 here, and 1, 2, 3, 4, 5. The 5 years. The next thing that I'm going to have is, again, beginning balance. Then I'm going to have the percentage. Depreciation percentage. Which percentage is going to be, for me, it's going to be 60%. Then I'm going to have amortization expense. Amortization expense. And amortization, the accumulated amortization. And the last one is my beginning balance. That's not going to be checked here. So let's make it normal. No highlights. Let's remove those one, no fill. And that will be the ending balance at the end. So again, my ending balance is the original cost. And I'm starting with the original cost. So beginning balance is 65,000. My depreciation percentage for the first year, 60%. And that's not going to change. Always going to be 60%, but it's going to be applied to the beginning balance. So my depreciation here is 60%. 60% here. Actually, this one's going to be equal to this one, and I can just easily move it all the way to the bottom. The next thing that I know is my amortization expense in total has to reach 60,000. I cannot go over 60,000. And my ending balance, it has to end up with 5,000. I cannot go anywhere less than 5,000. Make sense? This is my calculation. I can amortize only 60,000 and I can have to go all the way to 5,000. So let's go 60%. First year, I'm applying 60%. 65 times 60%. First year, I'm amortizing 39. And my accumulated amortization is 39. My ending balance is 65 minus the 39. 26, now I have to amortize. Beginning balance second year, starting with 26. I'm applying my 60% second year. I'm amortizing 15,600. Then I'm going to have here accumulated 39 first year plus 15, 54,600. And my ending balance is going to be previous year minus 15,600, 10,400. Next year, I'm going to start applying everything. 10,400, 60% is going to be 6,240. My accumulated amortization in this year is going to be $60,840. Can I do that?
I was about to say no.
No. Why? Because if I do this, what will be my ending balance? Now I'm below 5,000, correct? So how much I can only, how much should be my accumulated amortization? It should be $600, 60,000, correct? So when you're applying, so watch this, this is very important. When you're applying double declining method on the year, which amortization expense bring the accumulated amortization above amortizable cost, you ignoring the calculation and you manually adjusting the number. Make sense? So what you're gonna
How do
do
you
is
manually adjust the number? I'm a bit confused there.
watch this. Right now, this amount here is calculated balance time percentage,
Okay.
correct?
Yeah.
But if I do that, if I follow this calculation, I'm gonna go above 60,000, which I can't.
Okay.
So now I know here I have to reach 60,000. So what I'm gonna do, I'm gonna get this 60,000 minus the accumulated amortization up to this point. So on the last year, instead of following the formula, I'm gonna manually adjust it to bring me here to 60,000 and bring me here to 5,000.
Can
Make
you show
sense?
me that? Oh, okay. Can you show me that one more time, how you did it?
How I did it is my accumulated amortization is 54,600
Okay.
minus 60,400.
Yeah, it's the 5,400.
So how much I can amortize in year three? 5,400,
Only 5,400.
right?
Oh, okay.
So what's going to
Okay.
happen on the year four? Year four, we just follow the schedule. Sorry, this one, year four will be, beginning balance will be 5,000. How much will be my amortization expense? Can I take more? Come on, say it. Can I take amortization in year four?
No, you can't. So it
No,
would be 0.
0. Accumulated amortizations will be 60. Ending balance 5,000. How about the last year? Same. I'm not following anymore these percentages. I'm staying with where it's supposed to be. Make sense? Why? Because I'm amortize my assets over 3 years. So the question is, for what kind of asset we can use this method? This method we're going to use for the assets which are highly sensitive to technology, which we're taking the maximum benefits, and they're very useful in the beginning of the useful life of the asset, and later in the useful life, they're getting less kind of technology. So basically, if you have a last model laptop, which you just bought right now, he will be, uh, you have to amortize it over a very short period of time because technology, as you know, it's amortizing very fast. So you're taking the benefits in the very beginning of the useful life, and later of useful life, there's nothing left. So that's how you're using this method. So now the journal entry will be in the beginning, again, you purchased the truck was 65. Now the amortization here will be, the first year will be 39, second year will be 15,600, third year will be 5,400, sorry, wrong button, and the year 4 and 5 is nothing. Again, we're gonna reach our objective to get to 60,000, but the first year amortization will be 39, second year will be 15,600. So the second year amortization will be 15,600 here. Opposite. Now this one should read it from here, and this one should read it from here. So now the second year, what will be the residual value of our truck, the net amount of the truck on the presentation balance sheet? Again, the original cost 65, less accumulated amortization will be 39 plus 15,600. It's going to give us 10,400, which is exactly on our schedule, 10,400 at end of year two. And those are the three methods. Now, what you can do is, let's go to slides, and we're going to see how the double declining method is. I'll explain to you triple declining method. Let's see now the double declining. And later on, when I post you this Excel spreadsheet, you can fill the gaps for the double declining method. For the double declining method, again, we're going to use 40%, but we're going to start applying with the original. So 65 times 40%, we're going to give you 26. Accumulated amortization will be 26. The asset book value will be 39. Next year, starting with 39 times 40%, 15,600. We're going to 23,400. Next year, 23,400 times 390 times 40%, 9,360. Then we're going to the 50,960. The next year, left is 14,400, starting with 14,400. That's year 1, 2, 3, 4. 4,400. The fourth year, we finish with 8,424. So now, in the fifth year, if we starting with this and applying 40%, we're gonna go above the accumulated amortization of 60, but we cannot go over. So for that reason, we ignoring these percentages and we manually adjusting the balance because we know my asset book value is 8,424. My objective is to reach 5,000. How much is the difference between those two amounts? 3,424. Once I plugged for 3,424, this total is going to give me 60,000. Asset book value is going to be 5,000, and we're done. For that, once you see the year that accumulated amortization expense that you're calculating by the formula exceeding the total accumulated amortization that you have to amortize over the useful life of the asset, you're ignoring the calculation and manually adjusting to match the objective that you have. So if we have to compare the three methods, straight line method, unit of production, and double declining, both gonna give us exactly the same total. We're gonna amortize under each of the method 60,000. But as you can see, in the straight line method, amortization expense is exactly the same year over year. On the unit of production, however, is different based on the usage. Where the double declining method, in the first year of usage of the asset is high amortization, later on is less. Here, which method is gonna give us a highest first year amortization expense? Most likely double declining method, unless unit of production exceeding the double declining, but that's very rare case. So this is the graph, how it is each method. So the straight line method is straight line method. Double declining is extremely decline in the beginning and not so much in the later year, where the unit of production depends on the unit of production. Now, what's going to happen when we have to account for the taxes? Now, for those of you who are going to continue, I believe at this point, no, some of you may not continue with the accounting, correct? You still have a choice here to not to continue with the accounting. But if you continue with the accounting, we're going to see that we cannot deduct amortization for tax purposes. Canada Revenue saying, you know what? Your businesses and your accountants are very smart. You're using straight line methods, unit of production, double declining method. That's great. But that creates different expenses based on the method that you're using. We don't like that. For that reason, whatever you calculate and deducting from your income, company income as a amortization, add it back. And we're going to tell you how much you can deduct. So Canada Revenue come up with the term capital cost allowance, which is based on the Canada Revenue. They group different assets in different categories, and they give you the percentage that you can apply to that categories. So basically, for tax purposes, you have to do completely different calculation, but it's not going to be called amortization. It's going to be called capital cost allowance. They're going to tell you how much is allowable to deduct as a cost of the capital that you're using in your production during the period. And there's some complications, but again, you're going to see this on the tax courses when you see. Now, there are different assets, different categories, there are different approaches there, but this method for that Canada Revenue using is very similar to declining method. Is it going to be double? Is it going to be triple? You're going to see. Sometimes they allowed for the computers, for example, they allow you to deduct 50% capital cost allowance in the first year because they recognize that those are very time sensitive assets, so they have to be recognized, the amortized in the very beginning of the useful life. Now let's see what's going to happen if we have a partial year for our calculation purposes. If we have a partial year, then we have to go to the months. On the straight line method, that's why we calculated, I'll show you the calculation per year, but you can go one step down per month. So based on the month that you're purchasing, you can prorate it for the end of the year. How this gonna work? Obviously, we're never going to purchase the assets on January 1st because January 1st is start holiday, nobody's working. So in reality, either we're going to purchase on the before the 15th of the month or after the 15th of the month. Now, there's some kind of agreements or unwritten agreements or kind of policies. If you purchase the asset before the 15th of the month, you're considering that you have a full month of amortization. And if you purchase the asset after the 15th of the month, you're starting the calculating amortization from the next month. Something like that. For if you want to know how I am applying the amortization, so different people can do different policy. This is policy strictly for the company. When I was working, what was my policy? My policy it was when I purchase the asset, I never take amortization on the month of the purchase. I'm start amortization from the next full month. And that's how I'm doing it. But you have to understand, if you amortize the asset over 5 years, if the first year is short year, let's say 6 months, that means the last year also is going to be short year because you have to add to the full 12 months. Can I change the useful life of the amortizable asset? Yes, I can. But if I do that, then I have to revise the amortization schedule. How can I revise the amortization schedule? By going forward. Whatever you accumulated up to this point stays. You're not changing it. But when you're adding the new cost to the asset, then you're making new calculation, deducting the accumulated amortization up to this point. If you change the residual value, the new residual value, and divided by the remaining useful life of the asset. And that's how you're getting that, the new amortization for the machine. If I, as you can see for the declining method, I can amortize the asset on the year 3. Then if the asset is fully amortized, can I still use it? Absolutely. If you're still working with the asset, you can still use it. But can I deduct amortization expense? Not anymore. But you may continue to using the assets. And that's where I'm going to stop today. And for the disposal of property, plant, and equipment, we can discuss it next time. I believe we can have time next time to discuss this one and move to the next chapter.